This Week in Startups is brought to you by LinkedIn. LinkedIn has marketing tools to help you target your customers with precision. For a free $100 LinkedIn ad credit to launch your first campaign, go to linkedin.com/thisweekinstartups. And Squarespace. Check out squarespace.com for a free trial, and when you're ready to launch, use offer code TWIST to save 10% off your first purchase of a website or domain. And Vettery. Vettery is a hiring marketplace that connects top tech talent with growing companies. Salary Report is available to Twist listeners for free at vettery.com/twist.
Hey everybody, welcome to another episode of This Week in Startups. We're here live at the LAUNCH Incubator. Okay, so the LAUNCH Incubator is 7 companies. We do it a couple times a year. And we have great speakers who come and they meet the companies, they mentor them, and they give great talks. One of the great, legendary, early seed stage investors in the history of Silicon Valley is Jeff Clavier. He had Soft Tech Ventures, which is now called Uncork Capital, Uncork Capital. And he's going to talk to us tonight and share his experience. He's invested in over 200 startups. Many of them have gone on to great things. And he is not just one of the most successful, not just one of the longest lasting angel investors. He's also one of the great individuals in Silicon Valley who always takes an inordinate amount of time to help founders. He's known as one of the most helpful individuals in Silicon Valley, and I'm really glad he's here tonight. So please join me in welcoming Jeff Clavier.
Hello. Thank you, Jason. Hello, everyone, including the room and the podcast. It's a pleasure to be back. So the goal of this presentation is really to go through a few tips and tricks which I've learned over the years, both being on the investor side, but remember that VCs also raise capital. So we're in your shoes a part of the time. So just a bit about me. You can read my bio. Jason sort of covered it, so I won't really sort of add much. This is sort of the history of our funds. We've gone through sort of 5 funds of different kinds. Right now we're investing out of Fund 5, which is a $100 million seed fund, and we have an opportunity fund which does growth stage investment. You can go to uncorkcapital.com to learn more about us. I'm going to share a few sort of numbers, percentages. Just remember that each and every startup is different. And it's not because I say that it takes $1 million in ARR to get a Series A. It can apply to you. It can sometimes sort of not apply to you depending on your industry. But those are sort of good numbers that you can think of as averages. This is the agenda that I want to go through. So I want to give you a little bit of the VC side so you understand what our own psyche is. So when you raise capital, you understand where we're coming from. Then we'll go through a bit of the funding ecosystem, a few advice around your pitch deck, a few pieces around sort of raising, and then what I think is sort of interesting is the top 10 list of don't do this, otherwise you just screwed up your fundraising. So since I don't have that much time, I'll go sort of through a few things. At the end of the day, as I said, we raise cash from investors. They're called limited partners. They can be of different kinds, endowments, pension funds, funds of funds. But the whole point is we go and pass the hat the same way you do, except that we typically raise, larger amounts. When I go and raise capital now, I typically sort of go and seek $150 million. The good news is by now we raise it from the same people that we've been raising, for a while. VCs have a portfolio construction strategy, so they invest according to a set of filters that can be geography, stage, types of industries, and so on and so forth. And it's really important for you to understand that. When I raise a $100 million fund, the expectation is that I'm going to return it 4 times, right, on average. So to be in business, I get 100, I return 400. And that's how you guys sort of come in, because it's by investing in you that I need to sort of make all that performance. When people talk about home runs, depends on the fund you're talking to, but it's typically something that returns half the fund or the entire fund. So one deal returns 50 million or 100 million, that's a home run. When you reach out to us, through an introduction, always, as Jason, I'm sure, sort of told you, you're one of many. If you look at the average sort of Uncork here, we get about 3,000 investments that reach out to us in some form. Typically, it's email. We're going to meet a few hundreds. We're going to go into due diligence on a few dozens, and we'll invest in 15. So if you actually run the math, we say no 99.5% of the time. At the same time, when we invest, say, in 40 companies per fund over 3 years, the power law sort of applies, and only 10 to 15% of the companies actually matter to the performance because, only 3, 4, 5 companies per fund return so much of the cash that the rest kind of doesn't matter. So at the end, VC scale to us, when you hear, oh, we're not sure your VC scale, doesn't mean you don't have a interesting sort of business. It means that the scale at which you can operate will not actually contribute to returning my fund. And that's what I need, because I'm not sure when I start, who's going to return the fund, but I need that, at some point, 3 or 4 companies to go and do it. So for you to actually get a VC excited with your business, you basically need to be in the 1% that they say yes to, right? Because if you're in the 99.5, you'll get a no. So what you need to do is to do a lot of work, homework, that helps you sort of figure out of the universe of 600 micro VC funds. That's the good news for you. There are 600 micro VC funds out there now, right? When I got started, there were 1, and we were sort of 2 or 3. So there's a lot of potential sort of opportunities for you to raise money, but not all micro VC funds or VC funds, for that matter, are created equal. So you want to really sort of understand which ones are the right for you. Unfortunately for you on the podcast, we'll make the slides available, but this shows sort of how complex the funding ecosystem has become, so that when you double click on sort of seed, you now have pre-seed, real seed, post-seed, pre-A, whatever. But the point is, there's a bunch of different sort of people out there with funds that are looking at opportunities at different stages. Think about pre-seed as the stage that helps you build the product, seed as the stage that helps you launch the product, and post-seed as the bridge between seed and Series A. Not super helpful maybe in terms, because it doesn't really tell you what those people sort of have in terms of their own hurdles, but sort of think about it that way.
Let me just take a moment to tell you about LinkedIn. We use LinkedIn all the time to try to find great candidates, and it is working. We have quite a team here. And when you advertise on LinkedIn, which is the world's largest professional network, because we're all on there updating our profiles, including me. I keep my profile updated. I feel like I have to, because so many people see it because it's ranked so highly in search engines, and everybody reads it first before they meet with me. So I want to make sure it's tight. And these profiles have built this huge network that's very up to date. What that means is they have high quality leads there, and they can get you website traffic and higher brand awareness if you advertise on LinkedIn. You say, wait a second, you can advertise on LinkedIn? Yes, it's a new thing. And the first step is picking the right audience. Every day, 500 million professionals engage with content on LinkedIn. LinkedIn, is it right? 500 million a day. Wow. And your future customers are among them. So if you're trying to reach them, you're going to want to check out LinkedIn's advertising network. LinkedIn has marketing tools to help you target your customers with precision, right down to their job titles, company name, and industry. So this is really important. You could say, hey, I want to get all the people who are into robotics, and I want to show them the Misty and give them a discount code, huh? That's not a bad idea, is it?
Yeah.
Or you could say, hey, I want to give developers, I want to find people who can make accessories. And I want to just target them about the accessory program and coming to our accessory camp that we're going to host this summer at Misty Robots. I don't know if they're doing that, but that would be a good idea. And how do you find those people quick and easy? You go to their job title, you go to their company name, you go to their industry, and you create a better message that your customers care about, which in turn leads to more trust with your customers. In fact, 4 out of 5 customers on LinkedIn are decision makers at their company. That makes sense. You're listening to me on This Week in Startups. You have a LinkedIn page. You're a decision maker, so you understand that. So here is an incredible call to action. You can get $100, a C-Note, a Beaner, a big Hyundai, $100 LinkedIn ad credit, and you can launch your first campaign. Just go to linkedin.com/thisweekinstartups. You got to type out This Week in Startups. linkedin.com/thisweekinstartups. But for typing in all those characters, you're going to get $100, a C note from me and LinkedIn. That's right. Go get your C note, get your hundy, and start getting more customers. It's on me. It's on LinkedIn. It's mainly on me. Let's be honest here. LinkedIn.com/thisweekinstartups. I told you about the deal. Terms and conditions apply. Get that $100 ad credit.
It's really important as founders to understand one thing, is that the more time you spend getting ready for your seed round or Series A or whatever, the more research you do, the better you prepare, the less time you'll spend actually raising. So don't sort of rush and say, oh, I'm going to go and raise without sort of getting ready, because you'll basically waste your time and potentially burn funding opportunities. This is, so in terms of materials that you need to go and raise with, so pitch deck, everyone sort of knows that, 10, 12, 15 slides, figure out what you want to put in, but don't try and sort of put too much in. Remember that the cardinal rule is the first meeting's objective is to get a second meeting. You won't get a term sheet after the first meeting, so don't sort of go and do too much. We had really sort of good presentations today. I would just say those founders just packed so much information and spoke so fast that they could have sort of nudged down a little bit on the content and breathe a little bit more. So don't try and sort of put so much content out there that there's no time for question, because there will be a potential challenge. So pitch deck with a bunch of backup slides, get your due diligence, sort of ready. So it's, references on founders, potential customers, industry experts to validate, either your expertise, your science aspect, and so on and so forth, but to corroborate that what you have claimed actually sort of works. And then, depending on how much sort of data you have in terms of financials or whatever, have a 2 or 3 year model. As Jason said, look, it's not we won't sort of hold you to it too much. It's just to understand how you think about unit economics and scale. So the pitch deck in my book should really sort of address those questions. So, sorry, I'm just going to do the build. Okay. So what are you trying to build? What are you proposing? What is sort of the big vision? The how, the who, the why. So what is the secret sauce that you have, that will sort of get you to build a product? Who are you? We didn't spend that much time today on the founders. Early stage, like 50, 70% of the whole thing is based on the founder. So I like to start my meetings by, hey, what's your story? And that's a very open question that helps the founder really sort of weave in different part of their experience and personal story, and also why they're really so excited about the concept of spending the next 10 years building, one of those companies. Why now? You heard me sort of ask this today, because there's a lot of companies which had the original vision that, were just way too early. If you remember, Audio was a podcasting company before becoming Twitter. And it's not that podcasting today isn't successful. It was just, 12 years or 13 years too early. So why now do you have a chance of actually getting something to work? Where is it, the platforms? Where is it the distribution that really sort of enables you? Target customers, what's your go-to-market strategy? What is your competition? How big do we believe this can become? How are you going to, sell and price this? What are you going to be using, the capital you're going to be raising for? And, should you sort of have a demo or not is sort of an open question. I think for very consumer-y products, it could be useful, but as we've seen today with the first presentation that was dreadful in terms of quality of the tech, you may actually sort of fall into the death trap of the demo. So having a few slides, maybe a couple of videos is absolutely fine for the first presentation. You can always sort of drill down and have real demos in follow-on sort of meetings. Prepare. What you need to do is to make sure that you master your content, from front to back, just linearly and be ready for the annoying investors like me who ask questions every 30 seconds. You have two types of investors. The one that just doesn't say a word when you go through your presentation, and the one that just says, hey, about this, about that, and then essentially disrupts your flow and asks questions ahead of time or gets you to go backward. Look, you have to just master everything and be ready for anything. So practice, I mean, not like a robot, but like really sort of be very, very sort of familiar with the content. Make sure that the flow is really sort of comfortable, because it's not that we'll judge you on how good the presentation skills are, but you know, it does help. Do your pitch to what we call friendlies. So, you know, go to Jason, people who have seen hundreds of those pitches. So if you have advisors, go and pitch them. Fellow entrepreneurs who've raised a bunch of money as well. Existing investors, because they actually know more about the business and they can be really so helpful. But basically, get those sort of bad sort of pitch sessions out of the way by using your friends. And when are you ready is sort of, I mean, you could spend month sort of getting ready, but it's really sort of when you feel it flows and you're very comfortable that you're really sort of ready for those introductions and go and pitch. One question we often sort of talk about is, you know, how much should we be raising and at which valuation? And like anything in VC, we'll answer, well, it depends. And it depends on a few things, right? If you are, let's say, a second time or third time entrepreneur, then you will likely be able to skip, you know, sort of a seed round and go straight to Series A, because people will look at your past experience and track record and essentially fund you on that basis. Depends also on, you know, how good sort of the story is. If it's like a big, bold vision and it's like very binary, but the upside is massive, people may just go, okay, fine, you know, here is a bunch of money. But we'll look, especially at Uncork, at those three things: team, product, market opportunity. And for us, founders are a lot of the decision, but you know, we don't invest at ideation stage anymore. We really want to have a little bit of data, so we can make an investment decision. And so we look at, you know, product, market, a little bit of traction, and so on and so forth. The way to think about the amount you want to raise is really sort of related to dilution, right? The earlier you are, the higher the risk, the lower the valuation, and therefore the smaller the raise. Because let's say you want to really get to build the product and you need $100,000 and you don't have anything but you know, your ideas. Some people will sort of price you at 1, 2, 3 million pre, or maybe more these days because the market has been crazy. But the point is that will be sort of expensive capital. And so the early capital is at a low valuation, so it should be sort of limited so you don't dilute yourself too much. I like to think about it sort of this way, which is that the valuation is a measure of all the risks that have not been eliminated, whether it's in team, technology, production, go-to-market, you know, traction, so on and so forth. And when you hear about those, you know, crazy multi-hundred million or billion-dollar valuations, it's really sort of related to the fact that a lot of the risks have been taken off the table and you're really sort of in scaling mode. The advice I will give you is always like when people ask you, and what sort of valuation are you expecting? In the early days, when you don't have any sort of market feedback on valuation, just say that the market will sort of figure it out. If someone who is a recognized sort of investor, not your best buddy, because you know your best buddy wants the best for you, and will say, oh, you should absolutely raise at 15 pre. The problem is that if the market thinks you're at 5, the fact that you indicate 15 will be a problem. So you want to limit the signaling as much as possible and just say, look, market will decide. And like I said, dilution is really sort of the thing that you have to think about, because especially with convertible notes and safes, you don't really sort of get a feel of the valuation of the dilution of a round until you sort of do the math of what that safe converting really means to you and how much of the company you no longer own. Just a couple of examples of seed versus pre-seed. So a pre-seed round, look, these days, the normality is or normalcy sort of doesn't really mean much, but I would say typically a pre-seed round is under $1 million, and it's to help sort of build the product. You have an ecosystem of pre-seed sort of angels, firms, accelerators, angelist syndicates that will sort of help you sort of get those deals done. You'll typically raise for 9 to 12 months of runway. You have founders and maybe a couple of people, and you'll sort of build the product and then use that early traction or a couple of proof points that you will have gotten thanks to that product built to go and raise a seed round, which will have sort of a similar ecosystem, except that you have funds like us that will write large checks. So our average check size is $1 million, and will help you sort of get to $2-3 million round. And in those early days, a pre-seed round helps you sort of get to the seed round, which will help you get to the Series A, which will help you get to the Series B. And then eventually you may actually be in a dynamic where you can no longer sort of depend on financing. Remember what I said, which is to be successful, you really have to sort of identify the target investors for whom you will be in the top 1%. And even though it can be helpful to go and practice with investors who are not really sort of in your target, there's no point in going to chase anyone who has a VC vest like this one, because not every VC is the same. And the good news is that you have tools like Crunchbase or CB Insights or AngelList that help you sort of figure out which investors are investing at your stage in your geography, in your industry, for the type of product or sector that you're in, so on and so forth. And please, make sure that you don't send your deck and everything to someone who's investing in your direct competitor. You never want to sort of give notice to your competitors, but it just shows that you're a bit sloppy. So don't do that.
Ah, yes, Squarespace. I love Squarespace. It will turn your cool idea into a beautiful new website. Yes, you can showcase your work, you can blog, you can publish content, you can sell products and services of any kind. You can promote your physical or online business with Squarespace, or you can announce an upcoming event or a special project like we're doing for the Launch Angel Summit, or we're doing at Jason's Syndicate, a special project. And Squarespace will give you that beautiful template with world-class designers making them, and those templates look great on mobile and on desktop. So we call that responsive, right? They work everywhere. And if you want to buy a domain, they have over 200 plus extensions available. They give you analytics, they do built-in search engine optimization, and the hosting is free and secure. And of course, you're going to get that 24-hour-a-day, 7-day-a-week, award-winning customer support. So here is your call to action. Check out squarespace.com for a free trial. And when you're ready to launch your website, use the offer code TWIST, and you will save 10% off your first purchase of a website or domain. Make it yourself. Easily create a website just by yourself, just you. And make it stand out. Stand out with one of these beautiful templates created by world-class designers at Squarespace. Okay, thanks to my friends at Squarespace. You're doing a great job, and we really love using your product. Every day we use it here. Okay, let's get back to this amazing episode.
These days, you will have a lot of people who are excited to join a syndicate or join a round once it's done. And you'll hear a lot of people saying, I'm super excited once you found a lead. Which means it's pretty much useless, right? Because at the end of the day, you need to find a lead investor who's going to put terms, is going to define, sort of the contract that investors are going to use to invest into you, and then typically those lead investors will help you sort of wrap up the round. So, indications of interest are nice. Make sure to sort of collect them as indication of interest. Do not commit to them, because what you don't want is to come, to someone like me and say, so I'm raising, $2 million and I already have like 1.7 sort of committed. So that's awesome. I'm almost done, but I don't have a lead. And I'm going to go, yeah, but my average check size is $1 million. So sorry, can't help you. Boom. So get the indications of interest, put them somewhere, don't commit. Obviously, you've heard that as well, this notion of in a world where 99.5% of the companies get a no, the best way to get in front of someone is to use a trusted connection. It doesn't mean that it's impossible to go and get a meeting from someone, with a cold email. If you have sort of good copy, good title, whatever, you may get, through to the first meeting. But the law of large numbers, unfortunately, speaks against that. So I've done 202 investments in 14 years. Guess how many were actually coming from a cold email or from just a cold intro? Yep, 0. And it's not that I don't want to meet people or hear from them or whatever. It just happens to be like that. So why is it important? Think of it as if Jason tells me, hey, there is this awesome company you should absolutely meet because I'm interested, I'm invested, it's worth your time, because I trust, Jason, I will actually listen to you. I will listen to him. I didn't invest in Uber when he did that, unfortunately, but, I will listen to him. So it's really sort of about using the persons in between us and say, well, because I trust this person and, that person refers you, then you will sort of get more visibility, priority, and so on and so forth. The whole point of this process is like a sales job. So the same way you're going to have, your sales funnel, you're going to have your investment funnel. So you create your spreadsheets, you have the different firms, you're going to have the priorities, who actually can, refer you to them, and so on and so forth, and do that, like you would do a sales job, because it is a sales job. Sometimes people sort of come to us and say, hey, but how do I actually, do this? How can I, access investors if I have zero connection? Which is hard to believe in the world of LinkedIn and Facebook, but, it can sort of still happen. I remind people that there's this thing called revenues that is the best, non-dilutive sources of investment, because it doesn't, dilute you. So I think it's just not the way things are built. That's what we did, in the good old days. There was barely any sort of VC, so bootstrapping was sort of actually a way. The good news is incubators, accelerators are sort of available to you as this very easy sort of onboarding in the ecosystem. And for some of your immigrant founder sort of friends, I say, look, if you can actually go through an incubator, that's a way to scrub a little bit the fact that, otherwise people might be concerned about, the fact that you have a team which is remote and so on and so forth. So some of our own investments, because we only invest in the US, Silicon Valley, New York, Boston, and a little bit in Canada, but we have a ton of immigrant founders, mostly from Europe, but we invest in them, once they were here. And, a lot of them sort of went through an incubator to just help sort of get access to the ecosystem. The steps to financing, so the process will be, as I'm sure you've already heard, start with getting this intro to get the initial meeting. The initial meeting, if it's successful, will get you to a second meeting, maybe a third meeting, a bunch of sort of internal processes with the firm. Then they may sort of start due diligence, asking you for references, more plans, financials, spend more time with you, ask for, experts, do background checks. A bunch of different things that will sort of get them to a final sort of decision, which is typically sort of a partner meeting discussion. And then if they say, okay, fine, we want to invest, you will get a expression of interest with sort of rough terms. And people will say, hey, how about this? And you'll go, well, how about that? And, a little bit of negotiation. And eventually, you agree on terms, get a term sheet, sign the document, do a bit of legal due diligence. That's why we prefer equity rounds, because we actually go through full legal due diligence. Not so much because, it's safer for us, but also it allows us to pick up on any issue that the body you use to incorporate your company, because it was sort of cheaper than the big law firm, actually screwed up a bunch of things. And, the earlier you fix it, the cheaper. And I kid you not, sometimes you will, someone actually asked me, hey, should I use the $500 online, service or the $5,000 one? I'm like, don't you fucking do that. Just go and pay a lawyer who may differ, his fees, but you want to do the setup properly. You want to have the 83B election sort of done properly, because fixing those mistakes may cost tens or hundreds of thousands of dollars later. So don't be cheap on that one. Types of instruments. So we prefer equity financing. Yes, we'll do safes and convert notes, all capped, because there's no way people like us will sort of invest on uncapped notes. And you should. I mean, look, if someone says yes, why not? But it's really not aligning the investor and you. So equity financing is cheap enough now with standard model documents that it's better to have a great sort of legal basis for your future financing, because we have very founder-friendly documents that you want to use for the future. So it's better for you. Top 10 things that will lower your chances or screw up your chances to be funded. You would never do that, right? Send a to whom it may concern mass email putting all the VCs in the to. I think the best or worst I've seen was like something like 900 VCs. Think about like a list of 900 VCs collected, and and then you have one stupid VC who just replies to all. So I've had, and all those things I've had. So it's like, hey, I could sell to Google. I can raise around. What are the terms that will make me not sell to Google? Well, go sell to Google, because clearly you're not excited to build a big company. It's hard for entrepreneurs to always sort of have a good sense of the competition and the ecosystem, but that's your job to research, right? And so if you say, well, I don't have any competition and we can name 3 in one breath, it's an issue. That one is sort of more fuzzy, but sometimes as we spend time with some founders and we feel that they don't really have a grasp of either sort of go-to-market, the space, the competition, whatever, we'll have a, they don't know what they don't know kind of say, and whenever one of the partners at the firm says that, boom, deal done. So that means that you really have to know your stuff. Yeah, classic, using too many buzzwords. That was a good one. So once I had an entrepreneur who came to me and said, what would you say if, an entrepreneur had, 2 Nobel Peace Prize on the advisory board? And I replied, no. So like, it's always tempting to have big names and, large advisory boards for entrepreneurs. It's actually counterproductive. Just pick 2 or 3 people who are really good and really engaged and know you well and can really sort of vouch for you, because there's a high likelihood that someone who's well known we may know, and so someone who says, yeah, they're really legit and this is why I'm excited and that's why I'm involved and that's why I talk to the founder, every week, every month. That's the kind of sort of feedback you want. Yeah, trying to hide things is potentially the worst thing that you could try and do, because we'll figure shit out. Like anything that you think you can hide, we will that's our job. We'll sort of find it. So it's okay if you have made mistakes or have busted a company in the past or been fired or whatever. That won't prevent you from being funded. But if you try and hide it, that means that we don't establish a trust, relationship. Gone. Oh, and corollary, don't assume that VCs don't talk to each other. They do. The issue of, it's really hard to figure out what is sort of enough for a given round, right? And so you always sort of think about not getting too much dilution, but what's the right size of a pre-seed round? Well, typically $500,000 to $1 million, but at the right valuation, is it bad to raise $1.5 million? No, the answer is no. The question is always like, what is it allowing you to achieve? And what is the right valuation to sort of shoot for? And if there is a lot of excitement in the market and you get sort of high valuation, more power to you, but make sure you can grow into it. That's always what I'm worried about when some of our companies get beat up because there's a bunch of VCs who are excited and suddenly we get into the 100 and 200 and 300 and you're like, whoa, like like the company is making like blind revenue and look at the multiple, like, okay, fine, they can grow into it, but is it really realistic? So like a valuation which is too low is bad because it's too much dilution. A valuation which is too high is bad as well because it creates a lot of pressure on the team to execute and grow into that valuation. And if ever, you actually don't grow into that valuation, next round is going to be freaking brutal. So, this is a sort of a core. We're both, sort of playing a certain game of courtship. You try and sort of court investors. We try and court entrepreneurs. We want you to see that we're excited and interested. Remember that it's sort of the same. Trying to be too hands off or like playing I have a lot of traction with investors, so I'm replying to your emails or whatever. Or trying to put artificial pressure is a good way of getting investors who might otherwise be interested to work with you to just, drop. Because there's never only one deal we work on. There's always like a pipeline of 10. And so to get to the top, you have to put all your chances, on your side. So it's sort of stupid. We almost passed on an awesome deal because we had a founder who had an old computer and it was barely working, and the thing rebooted in the middle and froze and then rebooted, and we lost like 15 minutes, and then that poor gal was just like essentially like shocked by the whole thing. And like, just make sure you have rebooted your computer, use simple tools, have enough memory or whatever, because you don't want the tech to play against you, like unfortunately we saw in the first sort of demo today. As I told you, VCs are different. They have different styles. I'm the very involved and asking questions every 30 seconds. And if I don't do that, it means that it's just not that interesting to me. So be ready for me. But some people will just politely let you finish, and it's not that they're not interested. They're just accumulating their questions, and then at the end they will just hammer you with a bunch of questions, and that's okay. Just be ready for anything. My friend Mathilde, so I was lucky to lead the front sort of seed round, and Mathilde wrote about her Series A and Series B funding in a very, very transparent sort of way. Go and read, that sort of journey to Series A and then Series B. Not everyone can pull what she did, right? The whole like getting 10 term sheets in 1 week, it's pretty exceptional or unusual. And yeah, sort of a bunch of things that you shouldn't be doing to maximize your chances to actually have a successful fundraising. Can we take questions, Chief? And if you want to write me, I'm Jeff at Uncork Capital. I'm easy to find. I'm at Jeff on Twitter.
Okay, we'll take a couple of questions from the audience. A nice, concise question.
This is an LP question. As an LP, what kind of returns would you expect, an LP expect, from a fund like yours versus a later stage VC fund?
So we always try to sort of shoot for at least a 4 or 5x fund, and then some depending on depending on the companies and the returns. Later stage funds, bigger funds will be closer to 2 or 3x. I'm not an LP in sort of big funds, but we typically like seed stage, early stage funds typically perform better than way better than later stage.
Great. And why is it that this occurs this way? Do you have a theory?
I think it's if you really sort of pick the right portfolio and we really sort of get in the handful of companies that really sort of create very large returns, because our cost base is so low and the funds are smaller, the math is just easier for us to generate. Like, 100 million for me is sort of the max for a seed fund. I would never sort of go above, because then just the 4x becomes sort of harder to generate.
Hey everybody, let me tell you about a very cool new service called Vettery. It's Vettery. And it's a hiring marketplace that connects top tech talent with growing companies. All these candidates are vetted before they appear on the platform. Think about that for a second. They pre-vet all the candidates so you know they're high quality. And a new batch of candidates appears every Monday. How interesting is that? They just queue them up and you get all these pre-vetted, great tech talent ready to go. Now, this is great for startups or anyone looking to expand their tech team. And I know you're all having great success if you're listening to This Week in Startups. So they've released a comprehensive tech salary report for 2018, which will let you know exactly how much software engineers are getting paid. You can use this to make the right offers and build the best team. The salary report is available to Twist listeners, and it's available for the price of $0. That's right. Amazing. You can get this tremendous salary report, tremendous, huge salary report with these astronomical salaries. No, there's some good salaries in there. So here's what I want you to do. Here's your call to action. Go to vettery.com/twist. vettery.com/twist. TWIST. One more time. That URL is vettery.com/twist. And I'm going to give it a third time. vettery.com/twist. Okay, let's get back to this amazing episode.
And what's your typical ownership of when you're in a seed fund? What do you expect to own typically? Do you have a target or do you have a range?
We always go between 7 and 10% ownership of the companies, and we try and maintain that through to Series B. So check size at seed is $1 million average for 10%-ish, and then we maintain that a couple of times.
Great, let's take another question.
Thanks. My question's around founder conflict. So when you lead around, you take a board seat, let's say 6 months down the line, founders are having decent products, good progress, they're at each other's throats. Do VCs side with the CEO, or how do you go about that? How do you mitigate that risk and moderate that through to a conclusion?
That's a great question, and unfortunately that happens. We try to sort of understand the founder dynamic very early on before we invest. For us, as seed investors, we don't plan to work out the team. So we either invest in the team in front of us or we don't. It's not like I like those two, but that third, is gonna go. So we try and play coach. So we're between coaches and godfathers. So we try and help, support, get people to talk or whatever. That's why we always want you guys to vest your shares. Because I had the case where it was the first investment we've made in Canada, and they had no founder vesting. And I said, look, if you want me, you have to vest, because otherwise there's no way. They had 45% each, and they're like, no, no need, we love each other, whatever. So I forced them to put founder vesting in place, and lo and behold, 6 months later, exactly that, like each other's throat or whatever, and one of them. And we then return, all the invested shares to the company. Thank God, otherwise they would be dead. So we try and help facilitate a resolution, understand, so unless it's very clear for us who's right and who's wrong, we'll try and mitigate a solution, but eventually we'll do what is necessary to be done for the company.
Jeff, just a small technical follow-up question. When a co-founder leaves, and let's say they leave 20% of the company's cap table and it gets returned to the company, does the company typically just retire those shares, put them into the option pool? What happens with those shares?
Yeah, typically you would put them in the option pool.
And then give them to other team members possibly?
Because typically that founder was doing something, supposedly, and so you have to hire a replacement.
Got it. Okay, let's take another question.
Thank you so much. Quick question. Do you ever do postmortems after all the companies you invest in die?
We try to understand, yes, we do postmortems, and especially when you lose a lot of money, because that hurts. And so we try and understand what went wrong. And, it's not like, the company is doing great, and then boom, right? You see sort of a decline, you try and fix things, you try and change the course of, the inevitable. But if ever the company blows up, we try and understand what that means and where we sort of went wrong. Was it sort of the wrong team, the wrong thesis in terms of product or market? Was it the wrong timing? Was it the wrong, product environment, ecosystem, whatever? Or was it just we screwed up? And unfortunately, bad execution is a sort of a good reason to lose something which was otherwise pretty good.
And when you are doing one of your average funds, what percentage of your time as a fund manager is on the companies that are failing versus the ones that are the breakouts that equal 99% of your return?
So it's a great question, because we'll spend a lot of time on the things which are not working to try and make them work. And as a fiduciary, you'd say, well, you should just spend your time where you're going to make, your money so that you can make more money. But the whole point is, once you onboard someone in the portfolio, you're committing to them to be there for them. And so you'll sort of fight until the end, and you'll help, sort of shut them down or whatever, so that they can say, look, they were with me, when the Titanic sort of was sort of going down. And that will actually sort of get you to win deals, because people will, of course, reach out to your successful investments, but also go to the ones that didn't work and ask how you behaved. And so when you misbehave with something which isn't working, that actually has an opportunity cost as well.
And just a quick follow-up to that, which is when you look at founder behavior, and the arc has changed considerably since you started, where the investors had, I think, all the leverage, and now the founders have all the leverage. This has gone back and forth a couple of times. How do you manage extreme personalities that come with entrepreneurship, some of which involve people bending rules, maybe breaking rules? And has your thought on that changed over time?
Well, I think so you have to essentially establish very clear rules. I think recently we've had, sort of a ton of cases around sexual harassment, and there's absolutely zero tolerance in the team, in my team, for those kinds of behavior. And so whoever sort of misbehaves will, have the consequences. So we'll do whatever it takes to sort of understand and then act. I think bending the rules, like everyone understands that, hey, you could go through, it's better to ask for forgiveness than permission, but I think there are sort of limits, and you want to sort of establish those very clearly and have sort of a heart-to-heart conversation with the founders, especially if they are in an area where there are risks like that, to establish that you have sort of a common vision of what the company should do or should not do, and make sure you're comfortable with what they're ready to go for.
So if a founder came to you and said, we don't have a permit to put these scooters on the street. I'm assuming you're not an investor in scooter companies. And they said, listen, we're just going to try putting 50 of them out in Santa Monica and see what happens, because our interpretation is it's not against the rules. And what would your advice be to them, like, just candidly?
Well, go to the Transportation Commission or whatever and ask for, we would never invest in something like this, to be honest.
But other people would. Your competitors have.
Which is fine.
Yeah. Okay.
We'll see whether we laugh or not.
Yeah. Okay. Let's take another question.
I'm wondering specifically how you go about doing due diligence and finding out what people are hiding, and maybe if you have any interesting stories about that.
So due diligence in terms of what? Like the people, the background, the technology,
Well, you said, you mentioned not to hide anything, because no matter what, you'll find out. So I'm just wondering if you have specific techniques for.
Well, it's just the usual sort of networking. So if there's one thing I have after 18 years in this business, is I have a very, very, very large network, and so there's always someone who knows you, who knows me, and I can sort of go to that person and ask who I should ask about you. Without you're gonna give me a list of 3 references, I'll go and get 2 or more or 3 more references from people who I can talk to off list, as we call them, just to get a perspective on you. And it's not like trying to see what you hid, because we always sort of assume that it's like Jean-Jacques Rousseau, all humans are good, but we want to make sure that we understand all the facets of the person that we're about to spend 10 years working with.
As an investor, how do you balance deals that are referenced to you versus herd mentality in the investing community?
So I would say, because we've been around for so long, and there was no herd when I started, we basically sort of you'll never hear us ask who else is in. You'll never hear us sort of ask who else they've met. We'll sort of figure out whether this team, product, market opportunity, and sort of Series A financeability checks all the sort of filters and hurdles that we have in mind, and then we'll make our decision independently. And then sometimes we'll go into brand new territories, like I invested in Fitbit 10 years ago now, which no one was investing in hardware. And sometimes we'll sort of stay back, like we haven't done anything in crypto and don't plan to do anything in crypto. So we just have a set of beliefs and theses that we're comfortable with or not comfortable with.
I've got 3 white papers in the back for incredible crypto projects.
Awesome.
So these are the best white papers you'll ever read. Why have you chosen to stay in seed investing? Obviously, you have a lot of opportunity. What is it about the seed stage that has led you to stay in that stage specifically? Because one of the things that you and I have both seen is people kind of graduate,
Yep.
and Andreessen Horowitz or other firms keep making bigger funds, and it can have a little bit of a perverse effect on companies, overfunding. So talk about overfunding and why you chose to focus your energy, considerable energy, in this area.
Well, I think, look, it's first, it's my personal passion to really sort of take entrepreneurs from either the very early days or like the early days to get them to graduate to Series A's and Series B's, and sort of let them go in the hands of sort of great investors who will then get them to an IPO or a great exit. I think that for us to perform to the level of my expectation in terms of returns, 100 million is as largest I will sort of go in terms of the size of one of my funds, even though you could argue I'm cheating a little bit because I now have like 150. So I have another pocket of capital. I think it's the most interesting, the one where you can really have the broadest impact. That's where you sort of put those founders on a treadmill and you sort of go through kind of the same set of stages and types of hires. And so it's a bit more repetitive than when you sort of join at Series A, then you're sort of in for 12 years on the board, scaling the company. And that's awesome, but that's not what I want to do. I'd rather sort of work at that seed stage.
One thing I wanted to make note of in Jeff's Q&A session here is he doesn't care about social proof. And as founders, you need to understand what type of investor you're dealing with. There are investors who make their own decisions, and then there are ones who piggyback on other people's decisions. And I would say Jeff is one of the few seed funds that actually just makes their own decision. They take their own counsel, they figure out if they want to work with you, and then they cut the check. And it really is important to know which bucket they're in. And you could ask who else is involved, because you might want to know how big the round is, how much is filled in. This is important information to have to a certain extent, but what you'll find is once you get one of the big names that makes their own independent decisions, these other folks will follow on. And those people who follow on, they don't generally have conviction, so they may not follow on future rounds. So they're very, I find, fair weather. And I find some of them very frustrating. I've been on boards of them where they only put in money because they see somebody else notable did.
Yeah.
And then things get rough, and they don't even want to be on the board anymore and help the company.
I mean, look, it's... at the end of the day, you raise the money you can before the money you want. So you have a bunch of people who are super excited to join you, then you can actually be picky. The whole point, I mean, Jason sort of gives excellent examples, which is what you don't want is someone who backs you because I'm here. You want someone who's super excited to back you, period. And then, I'm going to co-invest and work with blah, blah, blah. But it doesn't matter. What you want is this sort of commitment to what you're trying to achieve.
I think that's well said. And on a marauding basis, getting any money from any of the top investors then makes everything easier. So I always tell people, if it's a great investor like Jeff and it's reasonable terms, just take the money. Don't overthink it. Just get the money in as quick as possible, because then, as you and I have seen, the other dominoes fall much easier. All right, let's give a big round of applause to Jeff. This is incredible. Well done.